there's a lot to unpack in markets today. There's certainly a lot of different factors at play here, and virus is still very much top of mind. So for the next 20 or so minutes, I'm going to try to focus on what we think are kind of the main things that investors should be paying attention to, and dive a little bit deeper into where we're specifically finding some opportunities. And with a little bit of an emphasis on, if you're trying to find income or cash flow on your investment, where are some of the areas that actually make sense today, given all of the different things that are going on in markets. And then I would love to hear from you to see if there's any questions that we could address. So just to jump into this, I do think, as we heard in the introduction, it's really hard to talk about investments today without at least acknowledging the virus, and that we're still going through a global pandemic, and we're not out of that yet. And I think, as you saw in the title of this, the uneven recovery is probably the best way to describe this, and that it really depends on where you're looking on a global basis to see how far along different countries are, either from a vaccination standpoint or from a reopening standpoint. And those two things are obviously very related. And where we stand today, you are certainly seeing a surge in new cases on a global basis. We do find some comfort in a few things. And I like to see the poll there that more than half or actually had their second dose. That's kind of what I like to see, because what we have witnessed on a global basis is where you're seeing a surge in cases, where there are also a high vaccination rate, the numbers look much better this time around. And the United Kingdom is a really good case study for how the rest of the world may play out as it relates to the virus. And what I mean by that is that they have been dealing with the Delta variant for some time now, and you've seen a spike in cases there. But what I think is most telling is they've also had a very good vaccination rollout. And so this wave that they're experiencing right now, the mortality rate is 95% lower than where it was in January. And so I think that's a really important takeaway, that as countries continue to fight through this and vaccination numbers continue to improve, the impact that you're likely to see from the virus will continue to wane. And so we don't think you're likely to see big global widespread shutdowns of economies. You may see some restrictions in place, and then we think that makes sense. But in terms of a global basis of what we saw happen last year, we don't think that's going to repeat. And that's important from an investing standpoint, because that means economies can continue to reopen, assuming that the vaccinations continue to improve across all of these different markets. So said simply, we are actually encouraged by what we've seen from a vaccination standpoint in terms of their ability to thwart the impact of the virus. But this is uneven, so it depends on where you're looking at. But if we look at some of the big markets on a global basis, the ones where you've seen a pretty large vaccination rollout, the numbers so far have been pretty encouraging. And that gives us a little bit of comfort that we can continue to move along, and the recovery that we're seeing can persist. Now, to jump into some of kind of the other factors that are at play here, you can't talk about the virus without also talking about what central banks and governments have done on a global basis, because their response to fight the virus has been nothing short of magnificent, epic, however you want to describe it, unprecedented. It's been huge. And so if you're an investor in markets today, this is a huge driving force. And so just to walk you through some charts here to describe just how big the response has been. And here we show you an example of US and Europe, and they've been leading the way in terms of what their governments and central banks have been doing in terms of the size of their response. But a lot of times what we were getting 2020 compared to was 2008, and we think there are the global financial crisis, and we think those are two very different episodes. And if you're looking on the left-hand side of the page, what we're showing you here is the economic loss of the global financial crisis in red, and the economic hit from the COVID-19 shock in yellow. And so you could see that the estimate of what the global financial crisis did, or what the global financial crisis did, versus the estimate of what the COVID-19 shock is likely to do when we get through this, is substantially less. And that's an encouraging thing. But when you look on the right-hand side of the page and you see how governments have responded to this in terms of fiscal policy. So putting cash directly in the hands of consumers and companies, it's been incredible, the size of the response. And so the US and Europe, long story short, it's been about 1/4 the shock, the economic shock, and the fiscal response has been about 4x of that. And so in many ways, a lot of consumers and companies are actually doing pretty well through this because of this fiscal response. In fact, if you were to take everything, all the different households across the globe, households have accumulated over $5 trillion in excess savings. So that means new cash that they have that they could spend. And it's one of the reasons that you've actually seen, again, this depends on what market you're looking at, but a pretty strong rebound in both markets and economic activity in 2021 as you've started to see that reopening happen because there's been a lot of pent-up demand. And we actually think that can persist here. And that's ultimately something that should be favorable for the broader global investing backdrop. The one thing that I think is important to keep in mind, though, is that when you're thinking about when global stocks generally do the best, it's usually when you're just starting to get into the recovery and you're starting to see economic activity accelerate. A lot of that started happening at the end of last year and the beginning parts of this year. And so if we look at the left-hand side of the page, you could see GDP estimates for major economies for 2021 and then for the following couple of years. And you could see that these estimates are now starting to come down a little bit. Growth is still expected to be very good, again, as the reopening momentum persists, but it's likely coming down from some of the peak levels that we saw. As I mentioned, this depends on what market you're looking at, but if we look at some of the biggest drivers of global growth, China, US, Europe, those markets still look pretty healthy from a growth standpoint, but we're moving past kind of the peak levels of growth activity. And equally as important and potentially even more important is we're also moving past some of the peak liquidity. So some of that response that I talked about started in 2020, continued in 2021, and it's still happening today. But you're starting to move past that. And on the right-hand side of the page, we're showing you liquidity growth. So you could just think of this as how much cash is going into the system. Most people pay attention to the US for this, given it's one of the biggest markets and most important central bank, the Federal Reserve. And so you could see the yellow line is the total amount of money supply in the system has gone up pretty sharply. The red line shows you the percentage growth over the last year on a rolling basis, and that has started to come down. And the implications for investors, we think, on this is the backdrop is still supported. There's still a lot of liquidity in the system. That's going to be good for global stocks. But we're moving past some of that peak growth and peak liquidity, which we ultimately think does create a bit more of a volatile environment. And that's exactly what we've seen play out over the course of the last couple of weeks. That's our expectation for the second half of the year, that there's still return to be had in different markets. In particular, we like stocks, as we'll get to, but there's likely to be a bit more volatility than we saw in the first half of the year on a global basis. So just moving along here, the one thing that is talked about a lot, if we go to the next slide, is inflation. And again, the US tends to be kind of the epicenter of this topic because that's where we're seeing some of the strongest inflation impulses, but also because it has implications for what the central bank there is going to do, the Federal Reserve. And so just a couple quick comments on this. And I would broadly say inflation matters for investors for two main reasons. The first is it erodes your purchasing power. Very simply, if there's higher inflation and you're in cash, that cash is worth less. And it could do the same thing if you're in low yielding bond markets. So it could be a drag on investment returns. So investors need to pay attention to inflation. The second main reason is what I alluded to, is that central banks don't like runaway inflation. So they're trying to manage this. They want to find the sweet spot for what inflation is. Most central banks globally think of this as kind of in that 2%. The major central banks think of it in that 2% range. We have been moving a lot higher than that more recently, notably in the US. And so there's a lot of charts on this page. I just want to call attention to a few things here. If you look on the left-hand part of the page, you could see that the most of the uptick in inflation that we're seeing, we would say about 80% of that is due to the reopening momentum. And we don't think that's going to last. And so while inflation is higher here, we ultimately think it's going to moderate as we continue to move along with the recovery. We don't think runaway inflation is in the cards for, again, for some of these major economies, the US and Europe probably most notably. That's an important thing when it comes to investing, because that means the Federal Reserve could remain patient in how they think about supporting this recovery. And they will be very deliberate about removing some of those accommodations that they've put in place that have been so critical to supporting that recovery. But just a few things to just highlight here, because there are some pretty staggering numbers to unpack as it relates to inflation. One of the main drivers of what we're seeing happen from an inflation standpoint is used cars in the US. So used cars are up about 34% from a year ago. If you've bought a used car really anywhere globally, you know that that's a depreciating asset. That does not appreciate normally. But because there's a shortage of new cars, a lot of this has to do with supply chain dynamics because of COVID. People are buying used cars. And so most of what you've seen be the uptick in inflation in the US is kind of this short-term impulse from people buying used cars. And that's denoted here in the yellow bars, where we think those of as the short-term things that are going to cause inflation to be higher, versus the red bars are the longer-term things that we don't think are ultimately going to move up. So long story short, inflation has been running hotter. A lot of this is due to the reopening momentum. It's been driven by the most cyclical parts of the economies. So think airfares, hotels, used cars. We ultimately think that that does moderate. That's important because runaway inflation is not in the cards from our perspective, and that will likely keep the Fed pretty patient, the Federal Reserve pretty patient and deliberate in terms of how they think about removing some of that accommodation, which has certainly helped economies and financial markets. So just moving along here in the sake of time, if we jump ahead, I'm going to skip this slide. I'm actually just going to go to slide 6. So just to shift gears and talk a little bit about the investing landscape. So again, if you're an investor today, there's a lot of different cross currents that you have to consider. The virus is certainly one of them, but ultimately we do think we could get past this. The vaccination has proven to be pretty effective in keeping hospitalizations and deaths down, which is the most important thing. There's still a lot of liquidity in the system from global central banks and governments supporting the recovery. We also think that's generally a favorable thing. There's a lot of excess savings, as I mentioned. All those things support the idea that the investing backdrop is still pretty good. The challenge becomes a little bit of some of this is already reflected in market pricing, and a lot of different areas of markets are no longer cheap. And again, it depends on where you're looking, but if we look across markets, you could see that a lot of areas are a bit more expensive. And the way to read this chart is we're showing you different asset classes in red are bonds and in green are stocks, measured against their own history. So higher is more expensive, lower is cheaper. The purple dot is where we are currently. And you could see, generally speaking, this is most pronounced on the bond side. And so that's an area where, as global multi-asset investors, we have been underweighting. We have not been owning as much in bonds, developed government bonds, or high quality corporate bonds, because we think of those as some of the most expensive parts of markets. Where we still think there are some value is within stocks. And we have been taking more of our exposure as investors within equity markets over the course of the last year. And you could see that most of the markets out there are above average from a valuation standpoint relative to their own history. What I think is important is if you compare equities to bonds, their valuation difference is actually still very much in favor of stocks. And so we think there's more room to run as it relates to equities, but you do have to be mindful that most markets are no longer cheap. And as I mentioned before, there's potentially a little bit of volatility to be had from here because of some of the virus dynamics and because of some of the evolution of central bank policy for the remainder of the year. To dive a little bit deeper into this, if you jump to the next slide, I think this is one of the most telling slides if I think of global capital markets and what we've seen play out year to date. What we're showing you here is a number of different asset classes on a global basis, and we're taking what their yields are. So how much do they yield? How much do they pay out in terms of cash? And we subtract the level of expected inflation in the US. And again, the expected level of inflation varies across a bunch of different markets, but generally speaking, it's been higher. We're using the US as just an example here. But you could see that there's a lot of bond markets today that don't provide you a return that's above the rate of expected inflation. And there's and you can see this on the left-hand side of the page, the areas in red. Now, if you shift to the right-hand side of the page, there are still a number of global markets, including emerging market debt and global equities and Asian fixed income, areas that actually provide you positive returns in excess of that of inflation. And the reason I think this is so important is because you're starting to see investors shift capital away from the left-hand side of the screen to the right-hand side of the screen. And so while these areas, no area we would really describe as super cheap, we do think the areas on the right will continue to be well supported because of the dynamics on the left, that investors can't afford to sit in cash and low yielding fixed income and not earn a return. So to jump ahead, if you go to the next slide here, just to talk real quickly about the fixed income landscape. As I mentioned, we're a bit more cautious on owning bonds today in a meaningful way because of where inflation levels are. And we do actually expect US interest rates to start moving up. And that, generally speaking, is going to be a negative for bondholders. Areas that we continue to like are US high yield bonds, so higher yielding corporate bonds, and Asian high yield bonds, corporate bonds. And what we're showing you on the page here, again, a lot of charts, but if you just focus your attention on the bottom two, we're showing you the total bar shows you the yield on these asset classes by calendar year, 5-year average, and where we are today. And it breaks it down in terms of how much of that is coming from the spread, or how much more do you get relative to a safe asset like US Treasuries. And you could see that today, even though US high yield has come down from its 5-year average, it's still pretty attractive, all things considered, at a 3.8% yield. Where you continue to see really high yielding opportunities is right where we are in Asia. And you can see that Asian high yield has a yield of 7.5%. Part of this reflects that it is a higher risk market and investors need to be selective here. But we continue to think of this as an area that is going to be well supported because of the lack of income and return in some of the developed markets, that investors are going to continue to put capital here in Asia because of the return and income opportunities that exist. If we just move on to the next slide and shift gears to talk a little bit about stocks and kind of where we're thinking we want to place our bets as it relates to equities. The big debate this year for global investors has been this whether you should be in growth stocks or value stocks. And you may have heard this, but ultimately it means, do you want to own companies that are growing at a rapid rate, or do you want to own really cheap companies that are generally more tied to the cyclical recovery? And on the left-hand side of the page, what we're showing you is growth stocks versus value stocks in red. And you could see in the course of 2020, growth stocks really, really outperformed. A lot of this had to do with technology. And so technology stocks are one of the biggest drivers of growth in broad indices. They were very much in demand throughout the course of 2020. As we moved into a period where that recovery really broadened out, some of the more cyclical parts of markets started to really outperform. Good examples of these are things like energy stocks or financial stocks. And you could see this as the red line comes down, that means value stocks are actually outperforming growth stocks. The green line here is showing you, though, that these things are generally related to interest rates. So as interest rates move up, generally growth stocks move down and value stocks move up. And in fact, this year, we've seen kind of a tale of two quarters, where if you were to look at the days that growth outperformed and the days that valued outperformed, it's in fact almost even. It's about 74 days versus 79 days. And I think the point here is that these things have been oscillating back and forth in 2021. And for us, we don't want to be making those calls. We think it's ultimately better off to have a little bit of exposure to both of these things. Things that are going to be driven by longer term secular forces and things that are really tied to the reopening momentum. Again, think things like financials and banks that benefit from a broader recovery. We think having exposure to both of those things are really important. On the right-hand side of the page, I would also emphasize for income-oriented investors, one way that we've been playing this is that if you look at global dividend stocks, they still look really attractive to us today. And there are a number of companies that you could find today that actually provide you a dividend yield. So the amount of income you get off of that stock that is actually higher than the corporate bond yield they have. So you could buy their bond or you could buy their stock. The stock actually provides a higher dividend yield today than their bond yield. And so for us, we've been leaning into that because we think those are types of areas that investors want to own given the backdrop, but they also look attractive relative to what you could achieve in bond markets today. And then the last point I would make just on the equity side is if you look on the right-hand side of this page on the dividend stock point, it's one of the few areas that have actually cheapened over the course of the last 5 years. And so what we're showing you here are valuation measures today versus 5 years ago. Today is in yellow, 5 years ago is in red. And we're showing you US equities, the S&P 500, NASDAQ, which is a technology index, and then dividend stocks all the way on the right. And you could see that that valuation measure has actually gone lower over the course of the last 5 years. And so that's an area that we actually still think makes sense today, again, especially considering the low interest rate backdrop that we find ourselves in. I'm going to pause there because I want to be mindful of the time. I know there's maybe a few other points that we could touch on, but I'd like to turn it back over to Marvin to maybe see if there are questions or comments that I could address, and then I'm happy to summarize some of the points that we discussed today.
Oh, thank you very much. That was an interesting talk, Zach. I really thank you for sharing us your ideas and your BlackRock's view. And it looks like the future global growth will still remain robust, but looks like risks are increasing. And interest rates are set to move higher and that markets are no longer cheap. I guess I want to ask you, that my question is, what are the biggest risks that investors are facing? And how do you think investors should manage their portfolios given these risks? Like how do we allocate these different asset classes you talk about?
Yeah, it's a really good question. So if I had to kind of summarize what I think the big risks are, and we kind of talked a little bit about these things, I think it comes down to a few main buckets. And I would emphasize that these aren't our base case, but they are risks to markets. And so inflation is clearly that. Like we are operating under the assumption that inflation is not going to be run away and not going to shoot meaningfully higher. I think broader markets are also thinking that. If in fact we are proven wrong and inflation is indeed higher than what most people are expecting, that is clearly a risk to market. I think investors, for a lot of the risks that we'll talk about, I think one of the ways that you manage this is owning things that can benefit from potentially a higher inflation environment. So generally speaking, that's not cash and government bonds. Those are areas that do not do well in an inflationary environment. If inflation is running a little bit firmer, but not substantially higher, that's still a decent environment for stocks. It generally means economic activity is robust. And that's one of the reasons that we have been leaning into equities. And in particular, if you find companies that actually have pricing power and moats around their business, that they could pass along those higher input costs, that's one of the ways that you as an investor could actually hedge against inflation, is finding those companies that in fact do that. So I think that's one of the ways that you could think about building a portfolio is cash and government bonds aren't going to look that attractive in a higher inflationary environment. Stocks should still do reasonably well there. And in particular, those kind of companies that are higher quality that have good earnings growth and that potentially could pass along some of those higher prices. The other two risks, I have to admit, I have less specific investment advice to this versus just saying, I think the way to manage against some of these risks are staying diversified and making sure the risk that you're taking is aligned with ultimately what the objectives of what you're trying to achieve are. The other two main risks that I still think are out there, virus is clearly one of them. And I think investors do need to be mindful of that, but our base case here is that that's not going to upset the global recovery. Mm-hmm. And then the last one would be geopolitical risk. And this is very difficult to predict, which is it's harder to say, this is what you should invest in considering geopolitical risk. The better way to maybe think about that is you should have diversification across different markets as a way to hedge against some of those risks. And an easy example of this is US and China tensions are still very clearly there, but we actually think investors should have exposure to both of those things in their portfolio. Because as those two countries start to decouple a bit more, there's cases for owning both of those in a portfolio. But long story short, those are kind of the main buckets of risk that I think we're paying very close attention to as investors. I go back to the old adage of staying very well diversified. The one result of the pandemic, and I know I apologize, it's a little bit of a long answer here. One result of the pandemic was investors on a global basis got very concentrated in their positioning. We saw this time and time again that investors, for whatever reason, had a greater willingness to take on individual stock risk in a meaningful way. Mm-hmm. And we think that's a more challenging thing to do at this stage as we continue to move through the cycle and valuations are a little bit more elevated. So I would say the idea of diversification holds true across any market. I think as you move forward from here, it may even become more important.
Thank you for that, Zach. So bond markets are not good, cash, but equities are okay. But we just have to be more diversified and maybe not get the growth ones and just more the value and the one that will be cyclical in nature. Thank you. Yes. But do you have some kind of summary of all of these things that you said? I don't know if you can give us some kind of a slide or a summary that has all of these mid-year views that you have. Do you have that?
Yeah, if we actually could pull up some of the slides again, I'll walk through what I think. Some of the main points here quickly, because as I said, it's a lot to unpack in 20 minutes in terms of what's going on in markets. But I think some of the main things, the driving forces behind markets, growth and inflation, these are important things to consider. Our expectation is that global growth is going to continue to be robust, but we're potentially coming down from some of those peak levels. And so the implications there are a little bit maybe more volatility because you're not in the early days when growth is starting to really accelerate. As the title of this presentation is, though, it's an uneven recovery. And so this is different depending on which markets you're looking at. That should go into how investors are thinking about their portfolios. Mm-hmm. Inflation, base case is that we're likely to see higher inflation here in the short term before it moderates. And we are not in the camp that there's going to be runaway inflation that upsets the recovery or causes central banks to hike interest rates too quickly or too aggressively. That has generally been the case in the past where you've seen economies and markets go lower when that happens. That's not our base case. In terms of the policy backdrop, to kind of further make that point, the fiscal policy response has still been fairly epic. And there's more in the pipeline in the US, most notably with a new infrastructure bill being debated right now. This matters for not just the US, it matters for global markets as well. We think that will continue to be a supportive backdrop. And then the Federal Reserve and other central banks, their policies are starting to evolve, but it's hard to define them in any other way other than saying they have been incredibly accommodative. And they're going to be very deliberate about removing any accommodations to not upset this recovery. And so we think those things are still pretty supportive. Mm-hmm. And then lastly, how do you think about this from an investment standpoint? Yes. I would generally say we've been favoring stocks over bonds and cash.
Mhm.
But doing so in a risk managed way, that means we're not owning 100% in stocks. It means we're doing this in a balanced way as global investors. For investors that are looking for income, we still think there's value in higher yielding corporate bonds in the US and in Asia. And then from an equity standpoint, as I mentioned before, we like the idea of having a bit of balance. So having exposure to some of those secular growth companies, but also trying to find exposure to things that could benefit from some of that reopening momentum. We are not in the camp where we're trying to call, is growth going to outperform today, or is value going to outperform? We think actually having a bit of balance to both of those things makes sense today.
Good. Thank you very much, Zach. A bit of balance. I think that's the key word. Diversified and balanced portfolio. That will really help you with this kind of a market. Thank you very much for giving us your time.
Yeah, thank you very much for having me.